Hey, welcome back to YT Finance, and today we are talking about the latest news updates for SoFi Technologies stock, Palantir Technologies stock, as well as what are the best stocks to buy right now that are under $20 per share. So for more videos just like this one, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. From the title of this article, you can see that we have a very bearish analyst saying that we shouldn't anticipate a 2023 recovery for SoFi Technologies, referring to their SOFI share price, which currently trades at $4.42, while professionals believe the company should be trading anywhere between $5 on the low end and $10 on the high end. Essentially, SoFi Technologies is a digital bank, and as we close out 2022, you can see that the SoFi share price has sold off significantly, and many investors are hoping that it will have a gigantic recovery in the year of 2023. However, this particular author does not agree with that. Rather, he thinks it's more likely that SoFi is going to stay on its current negative downward trajectory in its overall share price, mainly due to the student loan repayment moratorium being extended for the umpteenth time. He also says that this is going to negatively impact SoFi's overall profitability timeline and their future forecasts for when the company will become profitable on a GAAP basis, which again will cause the share price to drop even lower, and it leaves the company open to a severe pullback in their overall share price. Now, so far I'm tracking with him. I do understand that with the extension of the student loan moratorium, yes, this is negatively going to impact SoFi Technologies' profitability. However, I like how SoFi is diversifying their overall revenue streams to where this student loan moratorium extension will not actually hurt SoFi as much as some investors are thinking, because SoFi is not solely reliant on student loan refinancing as they were back in previous years. Thanks to 2022 and the volatile time that the company has had, they have diversified their overall revenue streams, making them more resilient and better positioned for 2023. I'd also want to point out that analysts currently have forecasts for this company to grow at a 33.6% revenue growth rate for the year of 2023. They're also set to narrow their overall losses from 42 cents per share down to just 25 cents per share, according to their EPS for the year of 2023. This is an amazing improvement from the prior years, and it shows that this company is rapidly growing and very quickly accelerating their overall timeline toward profitability. Now, the author does say that if SoFi fails to meet any estimates for 2023, it's going to be difficult for the SoFi stock price to move upward by a meaningful margin, and I agree with him. However, I'm not going to assume that SoFi is not going to meet their current projections, because as of right now, over a 30% CAGR in terms of their revenue and them radically improving their overall EPS, that is in the cards for SoFi Technologies. So although this particular author expects the company to stay in the red for the remainder of 2022, well into 2023, and potentially even 2024, I'm going to disagree with him. As we get closer to profitability for this company, we can see more investors actually start paying attention to this company and even invest into this company. Meanwhile, other speculative growth companies are going to continue to fall as the macroeconomic environment is extremely volatile. This is why investors are pulling their money out of risky investments such as speculative growth stocks, and they're putting their money more into bonds or very safe ETFs like VOO or VTI. Until 2024, we can see that the overall macroeconomic environment could remain quite volatile and overall very speculative, especially as interest rates continue to rise to get inflation under control, which needs to be done. This is going to cause temporary pain, but over the long term, this is going to be good for the overall economy. In the coming years, SoFi does appear to be hanging on to their overall value. This author believes this company is only worth their tangible book value, which currently comes in at $3.34. However, I think if this company reaches $3.34, this is going to be a fantastic buying opportunity in which the management of this company will most likely perform a reverse stock split. Because if SoFi Technologies does drop as low as their tangible book value, their PS ratio is going to be absolutely amazing, which would mean their risk to reward ratio definitely has a buy rating on it. But the author ends saying that the risk risk to reward position for SoFi is not really good right now and will improve in 2023, even though he believes it's going to stay suppressed. And he also highlights that SoFi earns a D rating from Portfolio Grader. But overall, I think the lower the stock price can go, the better opportunity it presents for an investment opportunity. However, do not overexpose yourself to this singular risky growth company. For me, I have less than a 5% allocation because I'm well diversified in other companies. Another such company would be Palantir Technologies, ticker symbol PLTR, which is a big data and analytics company that serves both commercial clients as well as government agencies. Palantir Technologies currently trades at $7.54, while professionals and experts in this space believe the company should be worth anywhere between $5 on the low end and $15 on the high end. Palantir has been one of the most searched stocks as of late, mainly due to their new partnership with Crisis24, which we talked about last video. On top of that, many media outlets are reporting rumors that this company is trying to revamp and reestablish the overall company's business prospects, which is going to increase their overall trend and make this company relevant again, which could further inflate their overall share price. But in the meantime, I do think this company is somewhat overvalued right now, and I believe that risky growth companies, including Palantir and SoFi Technologies, will most likely lose value over the next few months, considering what's happening with the macroeconomic environment. Remember, nothing is inherently wrong with these companies individually. However, because we are in a very negative environment right now for the overall economy, this is weighing down on single risky growth companies. Now, I'd like to highlight some technology stocks that are trading under $20 per share that many people are talking about. The first such technology company would be Upstart Holdings, ticker symbol UPST. And this company is trading under $20 per share because their current share price is $16.99. Analysts believe the company should be trading anywhere between $10 on the low end and $33 on the high end. But the author of this article believes all of these companies could give investors sizable returns and even become huge winners in the future. Now, for me, I don't really like Upstart Holdings and I'm not going to invest into them. If you're not familiar with this company, Upstart Holdings uses artificial intelligence to determine the credit worthiness of various people who want to take out a loan. They are trying to offset the traditional FICO scoring system for credit scores that originated with Fair Isaac. Upstart also claims that its new AI-powered algorithms can produce 53% fewer defaults on various loans while maintaining the same approval rating. So essentially, it allows institutions like banks to give out loans even more often with a lower amount of overall defaults. So that is very good if this actually works. However, other companies, including SoFi, already have certain underwriting policies that prevent this from happening. And right now, I just don't think Upstart is technically needed, even though I do think the FICO scoring system does need to be somewhat revamped. The reason I'm not crazy about Upstart right now is that as interest rates continue to rise, this is going to disrupt Upstart's overall performance. For instance, the stock has already fallen around 95% from its highs, and with increasing interest rates, this is not the company to bet on, at least not right now. So for me, I'm not buying Upstart, but I would love to hear your thoughts down below. The next company, we get a little better, where we are talking about Affirm Holdings, and their ticker symbol is AFRM, which currently trades at $11.91, while analysts believe the company should be trading anywhere between $10 on the low end and $46 on the high end. This is another fintech company that uses very innovative technology, and they are a buy now and pay later company. For instance, if I buy something that's $100, I can pay them in 4 installments of $25. And sometimes this can happen without any interest accruing, which makes them better than credit cards. However, Affirm's business is also very dependent on various interest rates, so they are very interest rate sensitive, and because of the current economy, I don't think this is a very wise investment as of right now, even though it could definitely have future growth potential. What I like about this company in particular is that the company has a very strong cash position on hand of $1.4 billion, so clearly they're well funded enough to survive and be resilient even during a weaker economy that is not conducive for their business model. The next company we have is SentinelOne, and this is probably my favorite pick from this list. The company is a cybersecurity company, and it currently trades at $15.82 per share, while professionals believe the company should be trading at $15 on the low end and $54 on the high end. SentinelOne uses artificial intelligence to be one of the best cybersecurity platforms to date, and the company also has a very good balance sheet by holding around $1.2 billion worth of cash and or cash equivalents, while they're just losing $67 million per year as of the last quarter. And although although this company isn't profitable as of right now, they're growing very rapidly, so I believe they will achieve profitability eventually. On top of that, their PS ratio has fallen from more than 100 down to just 12. So for a growth company, this company is primed for future growth. Lastly, we have a company that's comparable to Palantir Technologies, and that's called Amplitude, ticker symbol AMPL. And this company uses data to give companies the insights they need to become more proactive. The current AMPL share price is trading at $13.22, while professionals believe the company should be trading at $17 on the low end or $25 on the high end, so arguably this company could be considered undervalued as of right now. On top of that, the company has more than 1,900 customers as of the third quarter of 2022. It's a much younger company that is still burning through cash because, again, this company is not profitable, but their losses are overall minimal. On top of that, the stock price has fallen by around 85%, which has decreased their PS ratio down to just 6, which is very reasonable for this growth company, especially because it's growing its overall revenue by 30%. And with this revenue growth, they can break even on their overall financials, and I believe they are on a clear path toward profitability. So out of all of these companies, I would pick SentinelOne as my main pick from this list. And if you want more updates on Palantir Technologies as well as SoFi, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and I will see you in the next YT video.